Let me also welcome on board Indranil Pan, Chief Economist at Yes Bank, and figure out what he's anticipating from the data today. Indranil, hi, great to have you on the show, and wanted to understand what is it that you're penciling in for the advance number, because it seems like it's a subdued range. Like my colleague was just talking about the poll that he's conducted. It's 6.4 all the way to 6.8.
Yeah, so we are actually even lower than the 6.4 to 6.8 and the central tendency of the 6.5 that he pointed out. Yes, the government and the RBI are in the 6.5 to a 6.6 range, but we are at about a 6.2%. And I think the critical worry for us is mostly from the GVA and the manufacturing side. Now, if you really note the data on the Q2, the manufacturing had slowed down quite significantly to 2.2%. And that is also getting reflected in the stock markets, where markets have pulled back because there is a lack of growth in the manufacturing sector also to a very significant extent. So going forward, I think the critical thing that we are watching out is more the global perceptions on how and where input prices settle in line or in light with the tariff restrictions that are likely to come up. The currency has depreciated, which also raises the input costs of the manufacturing sector in India, which necessarily means that in the absence of a clear pickup in the domestic consumption and also global slowdown manifesting itself in a lower export growth, we should have a subdued sort of manufacturing production. Now, the same story from the expenditure side. We did talk about the lack of expenditure from the government side. And I think for the remaining part of the year and as we head into the budget, there could be still a bit of a struggle in terms of how the capex can sort of significantly revive on the higher side. But I think that is mostly the need of the hour, much more than, in my opinion, providing a boost through the budget to the consumption expenditure. Consumption expenditure boost can sustain for a shorter period. However, the infrastructure expenditure and providing a platform for the private capex to actually come back and kicking along with the government's expenditure will be the most crucial to drive the future growth trajectory of India.
Okay, fair enough. So your own estimates are actually lower than that, and you're expecting this manufacturing slash consumption slowdown perhaps to impact the numbers. But till how long do you expect this weakness to continue? When are you expecting a recovery in the recovery in the GDP figures?
Well, I think in terms of if we actually break down the story in terms of the first the goods and the services sector is definitely doing a lot better than the goods sector. And the second thing is if we break it down between the rural and the urban, I am somehow still not extremely confident of the urban sort of demand recovering pretty soon. And I think the critical reason is, yes, agriculture is positive, but do note that most of our farmers are marginal farmers, and they ultimately have to get back to the market to buy a certain sort of sets of commodities which they are not producing. And specifically in terms of, say, vegetable prices, etc., we have seen relatively higher vegetable price prints, which has also led to the per capita outlay on vegetables and food as per the last expenditure survey to have gone up, therefore limiting the expenditure scope for the discretionary items and the non-food items. The last but not the least, I think the problem is with inflation being on the higher side, the real wage growth is still sort of lagging in a very significant way. And that is seen across the urban segment and across the non-agricultural sort of rural segment, which in my opinion could actually restrict consumption growth to come back in a hurry. So I think it's still a few more quarters before we can actually see inflation coming down to the 4% handle. Of course, it depends a lot, even in terms of the tariffs and the commodity prices and the currency, and all those needs to be factored in. But yes, inflation is coming down, but it may actually be slow in terms of how it comes down, and therefore provides a boost to the real wages of the sectors that we talked about.
So, Indranil, next event would be the union budget, right? Next month, beginning. Wanted to understand what can the budget do being a blueprint to try and fillip growth? I mean, could we hear something on capex? Any specific steps to boost consumption?
Well, I personally would not sort of rely too much on the consumption boost story. Of course, I would continue to expect capex to be relatively pushed on the higher side. Now, the problem is that the budget has always sort of moved in the direction of only talking about fiscal consolidation, etc. And thanks to the sort of a significant amount of dividends that they have got from the Reserve Bank of India, and we are penciling in dividends not to be very low even in the current financial year, the central government does have a scope of continuing to push expenditures on the capex side. And I think that's where they must focus on, because that brings the efficiency gains in the economy. And of course, they have been lagging in terms of the interest-free loans that they were passing to the state governments because of some states going into polls, etc. So a hard look and a critical sort of incentive structure needs to be built so that the capex of the states also continue to pick up in the same line as of the central government. So that, I think, should be the critical focus. The other thing that I'm looking at personally is how they sharpen their last union budget sort of statement on employment and skill sort of generation in the economy. And that, I think, will create the productivity gains that the economy would be looking forward to, and also lead to a much more equitable distribution of income, and hence a better platform for consumption demand going forward.
For the fiscal year close, what is it that you're penciling in terms of a GDP print? And does it seem like there could be a fillip at all?
So obviously, as I said, for this year, we are looking at a 6.2 and broadly about a 10, 9.8 on 10 or 10% in terms of the nominal growth for the GDP. For the next year, in terms of the budgeting exercise, I have penciled in 9.5%, which may look to be a little on the lower side. So the real growth that I am expecting for the next year is at a 6.6%. Better than the current financial year, mainly on the fact that I'm expecting, as I said, some bit of a capex push to continue to happen from the center side. We are expecting, whenever the timing is, we are expecting some amount of monetary policy easing from the Reserve Bank of India, and some clarity in terms of the policies of Trump and the growth structure in the global atmosphere. So the risk atmosphere in the global system, that also stabilizing, means that there is a fillip for the emerging market growth structure. So all that taken together, I'm expecting a 6.6% for the next financial year, and broadly, given that the inflation is likely to come down, we are looking at deflation to be the overall sort of nominal GDP to be about 9.5%. For the next financial year, compared to the 9.8 to 10% that we are penciling in for this financial year.
Neil, great to have you on the show. Thanks as always for your time. And
Thank you.
If you like this video, then like, share and subscribe to ET Now.